G'day listeners and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I am excited. We have back in the room the big guns. We have big Teeuwsen, mate. Welcome back to the show.
Always good to be here, Sammy.
Always good to have you here, mate. Jimmy Ibrahim, mate, welcome back. Always good to have you. The Greys, mate, the Greys.
Yeah, the Greys are still there. G'day,
Silver dog
gentlemen.
himself.
G'day, listeners. Hope everyone's well. Looking forward to today's episode.
Likewise, mate.
Yes.
Likewise. Mr. Big Paul Karpierz, mate. Due to massive demand, you are back in the studio, mate. Welcome. Welcome back.
Thank you, Sammy. Thank you for the invite again up here. Love it.
No worries, mate. It is good. It is good.
I'm feeling a bit nervous, Sammy, because Paulie, apparently, people have been writing in that apparently Paulie is getting traction. He's trending, as they say in the modern world.
On SAP.
He's trending, and are we safe?
He's coming for our jobs.
Lukey's safe. Lukey's got a purpose. You're a fucked.
All right, well, this might be my last episode, everybody.
Listeners, we are back together for another Common Investor Mistakes episode. We had some really, really good, solid ratings and reviews from you guys. You took a lot away from the beginner style of the Common Investor Mistakes. So we're stepping it up a notch, guys, and we are moving into the intermediate level of investors and the mistakes that we commonly see. Now, guys, the way that we rate these, kind of from beginner to intermediate to advanced. Your beginners, your 0 to 2 level properties. So if you've got 0 to 2 properties and you want to listen, or it's worthwhile regardless of your level to make sure you're not making mistakes. I'd encourage you to go back and listen to the beginner version of Common Investor Mistakes. But from the intermediate side, from my point of view, an intermediate level investor is an investor that holds between 3 to 9 properties. And then coming up, if everyone still wants it, will be the advanced investor mistakes. 10 plus properties. But today, ladies and gentlemen, we are talking about the intermediate level common investor mistakes that we see. And I'm going to throw the mic directly to Teeuwsen.
Jimmy was getting ready. He's like, oh, shit, I don't have any content prepared.
No, he did.
Oh, no.
Jimmy knew I was going to take it off his shoulder. He looked at me and he's like, yeah, he's shaking his head. He knew it wasn't coming.
He had nothing ready.
All right, you took too long. Paul Karpierz!
That was a nice dummy pass, Sammy. Loved your work there.
Mate, thank you very much. I'm joking. Teeuwsen, mate. I want you to fire, mate. You got fired up in the last Common Investor Mistakes. I want you to fire up and I want you to smash out your points, mate. Ladies and gentlemen, they want to listen. They want to know, what are your common investor mistakes from the intermediate level?
I think the biggest one for me is not building the correct team. Like, a lot of people will get a few under their belt, and, you know, pretty much any broker in Australia could probably get someone 1 or 2 properties. I don't think there's all too much issue with that.
Well, if they couldn't do that, they probably don't have a job or a business, right? Because that's their whole job.
Should change professions.
That's it. But like where they really struggle is scaling people to your 3 to 5, your 10. So where we're talking about that 3 to 10 window, it's so important to have the correct team around you. One, from a finance point of view, very few investors get past 5 properties, and it's because they don't have the correct structuring or advice to actually know how to prolong their borrowing capacity. And obviously this is something we look after for clients and be able to actually scale them past that level.
I'd almost challenge it and say the majority of people get stuck between 1 to 4, 1 to 5, right? Like it's the very small minority that get above that sort of level and actually pick up more deals than, get beyond like a 5 to 6 property portfolio. So it's so common to see people get stuck, and the biggest thing they get stuck on is that financing piece, man, and having the right team around them to help guide them and keep pushing them through and working them forward towards the goals, mate. So, Lukey, mate, you've started off with a banger.
Can I just probe you a little bit on that one? What would you advise someone that is chatting with their broker? What kind of questions should they be asking them to see whether or not they're suitable to help them build out? And if they aren't suitable, how do they go about, doing that in that kind? Because it can be a bit awkward, especially if you've only bought the one deal. Just something practical for people to do.
Yeah, I think one of the things we talk about with people is go and ask them. We spoke about on the last Common Investor, beginner investor mistakes. Ask them how many portfolios you've built above 5, 10 properties. Do you have any clients that have built 20, 30, 50 properties? If not, they probably don't have the problem solving and the structuring and the strategy down pat. Pretty much all the brokers that we work with at APS are the top of their field.
Yeah. And they're
problem-
investors themselves.
Correct.
They're investors themselves. They
That's
buy
it.
property, they build portfolios as well. And I think that's really, really crucial. Man, it's the same as a buyer's agent. You wouldn't work with a buyer's agent that hadn't done what you were trying to do. And I think it's the same thing from a broker perspective. If they haven't built multiple 5, 10 plus property portfolios and they don't have a decent multi-property portfolio themselves, that's one of the things that I'd really be kind of grilling them on and seeing how much experience they have from that side. Because it's huge, man. Team is so important, and the broker is a fundamental part of that.
And it actually, I've noticed this a little bit on the calls, that people, when they're talking about their broker, they'll often say, yeah, he's a really nice guy. And I'm like, I respect that. And this is not about whether they're nice or not, but you need to have that conversation because whether they're nice or not is not going to help you get to where you want to get to. So don't get confused with, oh, he's a really good bloke, because that's not going to help you.
No.
I had one client say, I went back to my broker and I asked him a few questions about what you're talking about, because we were talking about some pretty advanced strategies, like 5, 6 properties. And they said, yeah, we could figure that out for you. I said, figuring it out, that's probably a pretty big red flag for you. So you've gotten to this point now. You need someone to get you to the next level. Like, you've got to 5 with someone that's figuring it out along the way. Imagine what you could do with someone that was all over it.
Yeah, or someone that shows you how to do it. Literally, they're showing you how to do it, and they kind of lay out the game plan and the roadmap for
You don't want to be
Game
the test
changer.
case, do you?
Absolutely. And when you're going to them and you're saying, hey, what do you think about us doing this? We've heard about this. They should actually be bringing those strategies and structures forward to you. Like, they should be saying, hey, you're at this point now. This is where I think we make the swap to this structure.
Yeah.
Or I think we go and swap to this bank because they will allow you to get this. So how do I get from 3 to 5, then 5 to 7, then 7 to 10? that is so hard. And that's where the correct team around you actually bring that forward to you. You shouldn't be bringing it to them.
No.
They should be saying, let's do this. This will get you this, and then we'll go here.
Yeah.
Yeah,
You
they're
know?
already preempting the hurdles ahead of time, aren't they? And already sort of forecasting what's going to happen from property 4 to 5, 5 to 6 once we get to those hurdles.
Because
So-
they've been through the problems
Yeah.
before.
Yeah,
They've
that's right.
dealt with it before with other clients. So
100%. You
I
have
think
to have a
that's
highly
massive.
experienced team. Yeah, for sure. It's absolutely crucial.
Yeah, that's
Good start.
That's number one. So the second one is rushing the process. So many people get in their heads, I've got 3 properties this year, but I really wanted 4. You still did great getting 3.
3 deals, yeah, still mad.
When you first started, you thought you couldn't do 1. Now you got 3, and look what you where you're at. But they get so caught up in, but I thought I could get 4. But I'm a big fan of setting your goals high. I think that's great. Just go for 4. And hitting 3, it's still a great achievement.
Yeah,
You know,
100%.
Think about how many people in Australia actually buy 3 properties a year. Very, very small percentage. So my biggest thing for point 2 is rushing the process. You don't have to go from property 3 to 10 overnight.
Yeah.
If you can, like, a lot of people never get to 5 to 10 properties. So, you're already so far on that journey. You don't have to rush it.
Keep the blinkers on.
Correct.
Keep the blinkers on your own story and your own journey.
Your journey's different to somebody else, that did 4 a year, or did 1 or 2 a year. you
Yeah,
know.
there might have been other people that are in the same position that only got the 1 or 2 a year, and you got the 3. So like ultimately, just because you're shooting for that big goal doesn't mean it necessarily is going to happen straight away in that first year. And the biggest thing we always talk about, if you stick to that consistent accumulation, you watch the snowball effect start to pick up and really take off within your own portfolio. Maybe in the first year, you didn't hit exactly what you wanted to, or maybe this is you going from 2 to 5 and you didn't get to the 6 or whatever. But the snowball effect of buying the right property, right location, at the right price in the next 6 to 12 months, that is going to snowball and compound as well. And I think it's an important thing, man. Like, it's great to set goals, and like 4 in a year, like I love that.
Huge.
That's aggressive.
That's
it's good.
massive.
But 3 years above average. To me, average is 2 a year. If you're not buying 2 a year and you're in accumulation phase, you're not doing enough. That's my honest opinion. If you want to get yourself to a mad position sooner rather than later, 2 a year to me is a minimum. 3 is going above average. 4 plus is nice and aggressive. It's good. But yeah, 3 is still a great result in a year, no questions.
It's interesting, right? We're talking about this and we're talking 2 properties a year, and our community will resonate with that. But even if I,
100%.
just the question you sent me, even if you were buying 1 property a year because that's all you could do, you're doing exceptional.
100%. It's still great.
Yeah.
But I would always be like, okay, well, how do I get to 2 a year? Because if you think about it, what you could do in 5 years compared to 10, what you can do in 5 years is the same as what you're trying to do in 10, but you're going to get an extra 5 years worth of growth because you're going to have acquired that portfolio 5 years sooner.
Yeah.
So I would be trying to move mountains to get yourself to that point where you can do 2 properties a year. Because to me, all right, 1 property a year is okay. Like it's okay, and you're still obviously moving the needle. But 2 a year is properly like you talk about rubber to the road. Like that is properly putting rubber to the road of your own portfolio and take it to the next level. And this is why I like to challenge people with this stuff as well. You know, like ultimately you want to achieve something significant in a short time frame. You're not doing it by doing it, you know, as slow as you can. But as you say, if it's all you can do, but then if that's all you can do in the first 1 year, 2 years, okay, how do we ramp this? How do we get this to the next level? And if servicing is the only piece that's wrong with it, okay, well, is there anything I can do to make more money? Because 1 or 2 deals with your skill set, if you're willing to work your ass off, you can bump that serviceability to get yourself to 3 or 4 or beyond as well. And with creative lending and understanding how to work that as well, you can definitely take it beyond that too. Like I can say this because I'm proof in the pudding of what I did within my own portfolio, making a very low income. So I think that all just comes down to sacrifice, being able to change the script there.
Yeah, part of the second point links into the third, but not rushing the process. A lot of people. Property 3 and 4 is so crucial to getting to the higher levels.
100%.
Yeah, you might have gone and we talked about setting the foundation last time we did this, and you know, setting those foundation with a few really good growth properties. You know, 1, 2, 3 potential bread and butters depending on your servicing capacity. But so many people rush out and grab a pre-approval, and they want to go and get the next one. I want to get to 3 or 4, and then they're maxed out.
So without going too deep on that, you got to correctly play the game. You got to play the game properly from that point to make sure you're not limiting yourself and you can keep moving forward from that perspective.
Correct. You want. I wasn't going in there, but you want to make sure you have a chat to whoever you're getting advice from before, like 3 and 4 is so
especially
critical.
if you're working with us, because that's what we help obviously all our clients strategize with as well. How do we keep moving you forward and keep going?
It's probably a massive hinge point. You know, that number. If you get it right, 3, 4, 5, you know, you will get to 10.
Yeah. But you get it wrong.
You get it wrong, you won't.
Stuck.
Yeah.
Because that's that snowball effect that you often talk about, Sammy. The snowball, that tipping point.
Yeah.
Where you get that 4 or 5 in, then you go back to number 1, then you're going back to number 2, and then that's where the real momentum
100%.
really starts taking place.
Yeah. So I actually love, like I don't talk so much about in school or property, the scenarios that I did, right? So I did how to build 60K, 120, 250, 500,000, and there's how to build $1 million net passive, right? So these are net passive targets, 60K net passive, 120, 250, and so on. And when we go through the scenario based around how to actually build that properly, and I break it down the video, I actually love doing it because I hadn't done it as like a whiteboard session for so many years, and actually doing it as a proper whiteboard session and breaking it down the way it all plays out. It actually, like, I get G'd up, like I get excited, I got excited doing it because man, it just makes so much sense especially when you map it out like that and you do it again in that way. And I mean, I talk about this with clients every single day of every single week. But yeah, man, it was cool to map it out and actually see it kind of come to fruition and how it plays out.
Because there's no guesswork, is there? That's the thing I love about the strategy. Is that if you do it well and you execute it correctly, why shouldn't you get that goal?
Yeah.
Because when you say to someone, you're going to get 100K passive or 200K, they're like, sounds good, I just can't see it.
Yeah. And that's where like the actual visual of it is crazy. And I think this is where like it all depends on serviceability. You know, income, which feeds into serviceability and available capital, will always depend on how hard someone can push and turn it and all the rest of it. But we've seen from so many of our clients that start with 1 deposit and in 12 months they get themselves to 2 or 3 properties. Like that is 100% achievable. And then it's a matter of playing that game correctly to be able to keep moving forward as well.
Beautiful.
Speaking of moving forward, Luke, you got anything else? Or
that's it.
Your wrap.
That's my top 3.
Good start,
That's a wrap.
Lukey. Good start. You came
Thanks,
strong
Jimmy.
today.
Well done.
I'm glad
mate.
we didn't start with you. We started strong.
I was hoping you were going to wear a different shirt, but that's all right. Go on.
Mr. Paul Karpierz, the fiery.
Well,
mate.
I've got a couple here for you all. So it's interesting, Lukey finishing off with his one and sort of building that foundation of the first 2 properties and then extracting that equity to then, you know, go into the next deal and the 4th deal after that. But then the scenario I sort of see a lot is you've got those early wins under the belt, you've extracted the equity out, but then you've gone and used that equity to buy an expensive car. Gone on an expensive holiday.
Yeah, right.
So
putting it towards personal expenses,
as
opposed to a personal, like lifestyle sort of things, instead of letting the portfolio snowball.
Potentially, there's nothing wrong with that, but is that then now getting you closer to your goals or further from your goals? And that's sort of the challenge.
You're seeing people not continue the sacrifice run, and they are what do you call it? Bloody delayed gratification is out the window because they want that win at that point, right?
You're almost seeing that next sort of shiny object, and it's sort of luring as you had that early win.
Yeah.
But then you stopped. You know, how are you going to proceed after that
Yeah.
to get to that
Such
next
a good
property.
point.
So-
Yeah, that's great.
Bloody such a good point.
That's great.
And
Equity releases for Mercedes, you trademarked.
it is so ridiculous. I mean, who are you fooling? That's why I would probe to people to ask yourself, don't think you're a baller if you pulled out some equity after a couple of deals and you bought a car, to think that all of a sudden now you've made it, because you're just pretending. I mean, if that's what's going to define you and make you feel good, and I'm not trying to judge people, but I think you need to have a real solid look at yourself and to ask yourself, is this in line with my goals? Like, really? Do you really need it now? I mean, personally, I drive a $30,000 car. I don't think I could even probably sell it for 30 grand, to be honest, probably now. But I don't, that's not defining me, but I'm delaying the gratification because I need to build out my portfolio to a certain point, and then I'm going to get the car that I would like. Right, it's not going to be a Ferrari.
You know what,
might be a
man?
Lamborghini.
You know what's a great point though, man? You saying that as well is like, you send me like defenders all the time. Yeah, bro, what do you think of this? What do you think of this? I'm like, man, that's actually decent value. Like that's not bad at all.
Yeah.
And then I say, man, like, come on, like you make decent money. You got multiple things sort of going on, everything, just starting a business or whatever and do that. And man, yeah, obviously without going too deep in everything, but man, it's funny because you're like, nah, I committed, like this is what I'm going to do in the portfolio. And mate, you could so easily do it. And you're a fellow that thinks highly of yourself. So to be driving around in a shitbox and
It's actually not too bad.
I'm only joking.
No,
but you know what I mean? Like you're someone who likes nice things, you know? And I think the fact that, and I look at big Paulie Karpierz next to me as well, still driving around his Honda Jazz. We're still waiting for the promo kickback Honda, but mate, it's honestly like we're
Drive away price.
Yeah.
32, 90.
But mate,
She's
it's
still
like
holding
delayed
on.
gratification, you know? You could have it, but you're like, well, if I was to go put 150, 250, whatever, into whatever level defender that you were to go and buy, man, it's going to like, it takes you further. You're not going to achieve your goals as quickly.
Yeah.
Whereas you're like, nah, I'm just going to finish this run to hit this many deals and get to this size portfolio. Then that's my reward at the back end of it. So, man, I love that, you know?
And also with that, and this is not about me, but I could buy that car with cash. I
Yes.
wouldn't even have to pull out equity. And
Are we swinging at the moment? are we?
but it's not.
He's
it's not, that's not-
helicoptering. He's
No,
going,
I know, I was felt on my foot.
what I'm trying to get people to realize is it's not as if I'm extracting the equity to use
Yeah,
it.
it's cash.
So the cash that I'm choosing not to invest in that just yet is because I want to put into a deal, because I said to myself that I was going to do it, and I want to prove that you set a goal, like achieve it first. Delay that gratification because it will be sweeter in the end. So
Have you watched the video in the course how to use property to buy a Ferrari?
I have not. No.
Guys, that is one.
I think
He's
it's
a level one
because
investor.
I think it's because I don't want a Ferrari or a Lamborghini. No, I don't want a Lamborghini.
Yeah,
McLaren. Anyway,
I'll buy a Matchbox one. What a gentleman.
So
Paulie.
my next point.
Jimmy's
so-
finally stopped talking.
Thanks, Jimmy. Appreciate that.
there you go. Back to
Handing
you,
it over.
boy. Back to you.
Cheers, Jimmy. So my next point is all about having adequate cash buffers. So at one point, we've got 3, 4, 5 properties. A lot can go wrong at that point in terms of repairs, maintenance, tenants may stop paying rental income. There may be an unforeseen circumstance with you and yourself, and sort of you're not earning your active income. So at a certain point in time, you want to make sure you have those adequate buffers to get you through those hurdles.
Would you actually say that obviously you need buffers the whole way through? It just they need to level up with the size of portfolio you're going as well.
Absolutely, I
Yeah.
agree. Yeah, so the larger we're scaling the portfolio, the
Yeah.
larger the buffers should be, apparently, like essentially,
Yeah,
to get
yeah.
us through those sort of hurdles in those moments that
Yeah.
we do face. So
100%. And you got to start, because actually it popped into my head because you and I were talking about this when we caught up for your investor story, and I think we actually forgot to go into it. But you had a little period there where your property managers change over something. There was like an inherited bloody PM. There was something wrong with something that went on with it, and then there was like a 2-month lag of no rent as we were evicting someone that wasn't a great fit, or someone that you'd put in and it didn't work out so well. And but then obviously you had the buffers to carry, even though insurance paid it back. Fix it, you got work done on the house as well, and you got the rent back from the obviously from the insurance company, but you needed those buffers to carry it through that little bit just to have that safety net, right?
yeah, that's right. Those
Yeah.
2 months, they were difficult, but
Yeah.
they'd be more difficult if I didn't have those cash buffers.
100%.
So by having that, it got me over that line.
Yeah.
And now
And so
I've come out on the other side a lot stronger.
Yeah, and so you didn't need to stress, and it showed the point of having them as well. So that's good.
Like the last thing you'd want to do is distress sell a property if you don't have the finances to support it.
Yeah,
So-
100%.
Perfect. And the buffers, you mentioned this previously, but just to recap them, just give us a rough idea, Sammy Boy, of the
mate,
buffers.
the buffers, guys, will always depend on an individual scenario. So if you're someone that's maybe a lower income earner, especially if you bought something that's negatively geared or heavily negatively geared. So almost all deals you buy in today's dollars, it's very hard to get something like a bread and butter, a growth property that's positive. But remember that I think in the beginner one that we did of this, the Common Investor Mistakes beginner, I'm racking my brain here, but I'm pretty sure we spoke about that investor that bought the BA bought him the deal was $25,000 per annum negative. They made 120 grand between the two of them. You know, that thing absolutely bled them dry. So for them, if they held an annual amount of bloody buffer against that property, you'd be talking $25,000 worth of buffer, which is massive for one deal. Most people starting out, if they've got very low living expenses, you know, maybe for the first deal, they get away with 5-10 grand, 2 deals. I used to work on 5 grand per property, and I started with interest rates as high as they are now, or they were even a tiny bit higher when I bought my first one in 09. And yeah, man, so it kind of really depends. But what I found was, as long as my portfolio was running pretty close to neutral, pretty much taking care of itself, I kind of went to 5 grand per property until I hit 4. And then that was obviously $20,000 buffer. And then I held 20 grand buffer until I got to 10. But I like to fly pretty close to the sun. And then when it was 10, that's when I raised it a fair bit after that as well. Okay. So it's always dependent on the individual situation. You have to understand how much a property is costing you. You know, what is maybe a 3-month hold period like Paulie had to go through. He went through his 2-month. But what's your 3-month hold period of buffer that's going to cause you no stress, no issues? And then don't touch it. Leave it there. Sit in the offset. Let it do its thing. It's there for a rainy day. It's another insurance policy. And it is very important. I know in my journey, I flew very close to the sun. There was a couple of times I went very, very close. You know, I probably should have had more than I did, but I pushed harder than most as well. So it's one of those things. You got to be careful. You got to be smart about it.
But we are talking about intermediate investors who are looking to build out. So if you are looking to go through the stages and get a 10 plus property portfolio, on the flip side of that, having too large of a buffer is actually halting your ability. So it's a fine line.
It is. I think it's being it's being aware of what the properties in your portfolio cost you to hold in currently high interest rate environment. Are they break even? Are they combined 20 grand negative, 20 grand positive? What is the situation? Understanding that, understanding your incomes, and then whatever makes you sleep at night without exactly being silly and being too low or stupid and being too high.
Perfect. Nice one, Paulie. That was a good one.
Yeah, so the last and third point I've got here is opting out of property investing just due to government policy changes, new tax levies being introduced. You know, there's murmurs and talks right now about the scrapping of negative gearing, you know, removing the 50% CGT discount. You know, there was land tax thresholds that have changed recently in Victoria. We had the Queensland land tax issue a couple of years back, and you know, all these sort of factors, you know, get into people's ears, and perhaps they don't continue the journey because of them. And sort of I look at it as, you know, this is just another sort of sticking point. You know, we get beyond this and we see ourselves on the other side to keep pushing.
I think it's a great point. It's always a little blip in the radar. Like things come in, they come, they go, all the rest of things. And if things hang around, if something comes in, does hang around, it just becomes a new norm in investing. You know, it should never really sway your decision whether you should be investing or not. If something changes and something, you know, no longer becomes a great area or great state potentially to invest in because of some change that happens and you've got an existing portfolio, change up a state. There's going to be somewhere else that you're going to be able to buy and continue investing. I always bang on about it. Jimmy and I always bang on about the consistent accumulation. It should never, ever change unless something significant happens in your personal situation. But in looking at the market, there's always somewhere worth investing in. So if you stick to that consistent accumulation and really just continue that thought train and keep punching it like that, you're going to succeed. You know, the law of average is 100% going to be in your favor, especially using the right people as well. But yeah, it's gonna work in your favor over time. So by sticking to it like that.
Nice, Paulie. Yeah. Well done.
No, thank you.
Very succinct. Love it.
Love it, Paulie. Anything else, mate? All capped out?
That's covered me from my perspective. Yeah.
Beautiful.
What about you, Sammy boy?
Mate, my biggest ones are probably the biggest thing is lower tier lending. So there's a lot of people where they start moving away from the mainstream. It's like, oh, I don't want to pay that much as a rate. Oh, I don't want to pay a 0.5% establishment fee, all these little things. And they don't understand that is just a cost of doing business to continue to play the game. If I hadn't taken on lower tier lending, I would have been stuck at 2 or 3 properties, right? Like I would have been stuck out of mainstream at that point. And understanding that was the avenue that I had to go down to keep moving forward. It was just it was something that I had to take on board, cop it on the chin, whether I do it or don't. I get a lot of the time where someone even said this to me the other day. It's like, oh, well, I'm not going to buy anything this year because the cheapest interest rate I can get is 8%. They're a reasonably high income earner. It's a couple, and I'm like, okay. What's the trade-off of you buying this year versus not buying this year? It's like, oh, well, I'll wait for the rates to come down, my serviceability increase because rates come back down. I'll be able to go to a different lender, yada, yada, all the normal excuses in my mind of not investing. And they are currently holding probably like a 7 or 8 property portfolio. So they're actually quite advanced as investors and they're sitting in a pretty good spot. They're about to build a couple of grannies. And I understand the reservation, the hesitation, but they got a very big buffer. And when I look at it, 1% difference in interest rates, like let's say between 8 and a 7, right? Or an 8 and a 6, 2%, which you can't get 6% interest rates right now. But let's say even from either of those amounts, for every $1 million worth of debt that you take on, that's 10 to 20 grand a year in interest cost. 10 grand for 1%, 20 grand for 2%. Over the course of a year, difference from 6 or 7%, right? So you're talking about a $10,000 to $20,000 difference to take on that debt. Now, $1 million worth of debt, that could get you into 2 to 3 properties. But you think, let's say it got you into, even just use the $1 million example. Let's say it was fully leveraged and you bought it in the right place at the right time, at the right property, and all it did was 10%, just 10%, which is small, right? We make 5% on the way in. The market does 5% growth. Can't remember. APS has never had an average that low. You're still 10xing the extra 1% it costs because the 1% extra in interest was an extra $10,000 that year in holding cost, but your properties went up 10%. That's $100,000 return on that million. So you got so for the extra 1%, right? For the extra 10 grand, you've made 100. What if that market goes up 15, 20, 30% in terms of growth over that window? We're talking 150, 200, potentially $300,000 as capital growth for the exchange of 10 grand on the front end. Now, if you were in a position where you couldn't hold the negative cash flow, different story. If you couldn't hold that property with the extra 10, 20 grand, whatever it was over that course from that perspective, different story. These guys could. And when I looked at it and I explained it to them, I was like, to me, that's a no-brainer. Obviously, it's not financial advice, but if this is my own portfolio, I was having a look at this is something to think about. Maybe you need to have a chat with a financial advisor, broker, all the rest of this sort of stuff, run the numbers, see where you're at. They had the ability to absorb the extra $10,000 difference and tapping themselves out of the market. And they have massive goals in a short period of time. And I'm like, caveat on this, you don't do it. The massive goals you're trying to achieve in a short time frame, you're not going to do it. You're not going to achieve it in that time frame. And I think it's probably one of the biggest mistakes I see of the intermediate level investors, in particular kind of 3, 4 up to probably, or up, right? 3 to 4 to 6, 7. These investors in particular had 7 or 8 properties. It's the biggest mistake I see because they max with mainstreams. They go to second tiers, or maybe they go to the seconds and then they go to the thirds. And as of right now, and the capital they got available, maybe they're going in at 88% lens, and that is what the interest rates are at 8%. And when I explain that, most people are like, yeah, all right, that makes sense. You know what I mean? And they either do or they don't have that capacity to go to the next level from a surplus, income or cash flow perspective within the portfolio. So as one final example around this as well, I remember in COVID when interest rates were about 2.5% to 3%, especially when they did that big slash to make sure the economy didn't crash when COVID first hit, I was paying in the 5s and the 6s for my interest. And everyone else was paying 2.5% to 3%. I was paying in the 5s and 6s for low doc lending. I low docked the hell out of my portfolio. It was literally my first year in business. So I couldn't even use business financials, and I had to use that. And I bought, it was 11 properties in Brisbane between about 250 and 350,000. They would all be worth between 6 to 750. Just the houses now, let alone the ones that I built on top of them as well. They all did more than 100% growth. And when you think about it, if you're talking 250, 300,000 plus per deal, 11 deals, we're talking 3 to 4 million on an exact number these days, but 3 to 4 million that I made off the back of those purchases when I probably should have taken a year off. Most people would have taken that year off. And that was a year that took me, that was when I went from 20 to 30 properties in a 12-month window, was off the back of that. And if I had sat on the sidelines, that's a few Ferraris.
That's a pretty good example.
That's some kahunas.
That is.
That's some kahunas.
Well, that's backing yourself. I mean, clearly you do the research and you know the market.
But you don't need to even go in at that crazy level. You don't even need to go 10, 11. I saw the gap in the market. I was out there sourcing deals for clients. It was the middle of COVID. I didn't have that many clients. So I was like, I'm not going to pass up these opportunities. Some of these things were like $50, $60, $100,000 below market.
I bought it myself.
Renovations. I did, man. I bought it myself. Some of them I went and renovated. Some were fine and all the rest of it. And I was like, didn't have people for them. Had the opportunities. People were cutting a sell to get out of the market. Great opportunity in the market. And, a lot of people get revved up by our take on the market at the moment, which is the super boom, right? And they're so excited about it. But then there's some people, they're so excited, but they're not willing to pull the trigger with the interest rates. And it's like, well, if you believe in it that much, isn't worth rolling the dice.
You know, the irony of that situation is they're waiting for the interest rates to pull back.
Yeah.
So the fact that they don't want to buy,
Yeah.
but interest rates are going to pull back. So wouldn't want to buy now, ride that growth, and then get the interest rates pulling back.
Yeah. and then the next raise of growth, plus
So-
they'll have undoubtedly have rental growth in that time frame. And when interest rates come back, it comes back and they get back to the moot point anyway. And they'll probably be able to refi down to lower lenders.
But you said they're waiting. They're waiting with everyone else.
Yeah.
Yeah.
You know, everyone
The
else
masses,
is waiting with
yeah.
them.
It does surprise me because they've got so many properties already that you would think. But,
Yep.
you know, human behavior.
Exactly.
Yeah.
And you can't, the old saying, you can lead a horse to water. You can't make it drink. You know,
Yep.
it's as simple as that. So some people you can help, and but it's not everyone, right? So all we can do is give our perspective. Once again, guys, not financial advice, something to consider, but not necessarily implement. Not financial advice. Moving on, guys. Probably the next big thing for me is moving away from what's worked for someone. So someone makes a bit of money out there in the marketplace. Maybe they're replicating, our strategy, working with us, building these deals out and everything. They get all amped up. They make $1 million in 3 years off 3-4 deals or whatever. And then they go, you know what? Development's mad, yeah? Development's where it's at. It's where it makes the money. So I'm going to pull all my equity out, or I'm going to sell everything down and take all that cash, and I'm going to go do a development. And they go and try and go to a level that they're not at yet and that they don't understand. And they either put all their eggs in that basket, or they strip everything up and then roll it into that, when they could have kept proceeding with the correct strategy that would actually move them more towards their goals and keep moving from that end. And I have always found well-placed bread and butters will always outperform a development. Always. No questions. With so much less risk. I have no issues with developments. For me, developments are on the back end. They're debt reduction plays, DRDs, debt reduction deals. They're for the back end to debt reduce the final end of your portfolio. When you have gotten to the level of investor that can take something like that on and it's not going to cripple you. So many people, they try and get in there super early and they bring their portfolios undone by trying to do developments too early. And it's across the board as well. It's understanding when you even need to do cash flow deals, because cash flow deals can be capital intensive depending on the deals that we're doing as well. I see it all the time with people trying to go into commercial. They make good money on a resi portfolio and then they'll either strip it all out or they'll sell 2-3 deals down. And they'll go park it all in the commercial and they get a half decent net yield, but all their money's tied up and they can't move forward. They're fucking stuck. And they got a half decent yield when they could have leveraged and kept moving forward and still retain the portfolio that's going to keep giving them the capital to keep moving forward. I said way too often people sticking their money in super high capital deals, or capital intensive deals, regardless of what they are, and then tapping themselves out and the journey's done. Or it's done for the next few years. They can't get that cash back out. They're stuck.
And that's without the tenant leaving. How many times have we seen commercial properties? It looks great when you purchase it. Tenant moves out. You can't find another one for 3-6 months.
How many strategies have we had where someone's bought a deal, or someone's bought a commercial deal for someone, and then 3 months post it when they move out and it's vacant for 3, 6, 12 months or longer, and their value goes down because they can't lease it at the same amount. It's like it has its place in the portfolio. It is definitely not at the beginning.
But you're also talking about a large asset generally too.
Yeah.
You got more debt within a resi property generally speaking. And if they're unrented and you don't have the backing or the passive income from your resi portfolio, you can get yourself in strife pretty quickly.
Yeah.
That's why we're so pro, building a solid foundation of not only equity, but also cash flow too before you do anything like that.
Yeah. Yeah, man, I completely agree with you. Boys, moving on. My final one is it probably flows on a little bit from the first one as well, but it has got a little bit of a different take, but being too confident in your own ability, right? So I saw this a lot in Sydney. Sydney was one of the big ones where a couple people went out and they bought things and then they went up in the next 3 years. They went up, maybe their one property went up 300 grand or something, and they pulled all that equity out in 2017, and then they bought 2 more, and then the market tanked, right? And I've seen this before so many times, and people have done it in past cycles when all the strategies I've been on and spoken to so many people, and so often they'll do it. They have the win. I actually had this with a client, young fella. We'll get him on the potty one day. He did really, really well in Tassie. Young battler. I literally had a strategy with him a couple of weeks ago. And man, he did so well buying really cheap properties down there. He was in Tassie. He was in the correction system, and he would go out and renovate these properties himself. Everyone was trying to talk him out of it. He kept going. He kept doing it. Did really, really well. And he just kept buying in Tassie. It didn't diversify, and Tassie peaked out. And then he did his biggest deal was the final deal he did in Tassie, and he's actually come back a little bit in value on that deal. So the deal he's done, all the others have done quite well. And we're having to go through a re-strategy phase of potentially offloading it because he's stuck now. He's stuck with where he is. He did really, really well, but he's stuck way too much in the same thing. And I love it because he's come to us and he's like, I just need help. I did well in Tassie, but I don't know how to do anything else anywhere else. And man, I had the best strategy with him the other day, and I'm super pumped to take him to that next level. And I was just blunt and direct with him, and because he goes, what should I do? And I just said, mate, you made a mistake on the last one. When you take a step or two back, to then go to the next level and to keep you moving forward as well. So it's really, that was great to be able to work through it with him. But I see it a lot of the time where people, they'll pull it out and they'll try and buy at the top. But the issue is if you pull all your equity out and then buy at the top of the same market, maybe one or two deals, and then they go down, your overall equity position can sometimes get into the negative, especially if you buy too far along the peak or you miss the top. And I see this a lot when people just kind of, they fluke a decent deal, or they bought a deal and COVID gave it a bump or whatever. And then they either believe in the area so wholeheartedly because it's already produced for them, or they just believe in their own ability too much. They kind of hype themselves up too much without the proper backing behind it. You know what I mean? So they're probably my three key things that I see the most with people, kind of day in, day out sort of side things. Yeah, man. And any comments, boys? We didn't jump in on too many.
No, I think they were good. Like, we see that.
Thanks, Luke.
Thank
you for your vindication.
Let's go on to Jimmy, eh? No, but we see that all the time in strategies. I see it a lot with like people going, oh, I've got 500K equity now. Oh, my mate told me about this commercial deal. What do you reckon? And they're looking at you for, should I do it? No. Exactly what Sam said. Yes, you built a foundation, but you can mess things up pretty quickly.
I think I've said this often on the podcast about developing, and my brother-in-law who's done quite a few townhouses.
Yeah.
And I just always thought that was the only way you made money.
Yeah.
And I remember listening to someone a long time ago talk about property, and he was saying, you want to make the most amount of money with the least amount of work and effort. And I was thinking, that's just so counterintuitive to life. I was thinking, this guy, I just couldn't get my head around that psyche in terms of the property. So thinking, harder you work, the better it is, blah, blah, blah. It wasn't until we started doing deals and I started to realize, the bread and butter deals, we often say 80% of the heavy lifting is really just buying in the right market. Yeah. So why would you tie up all this capital for 2 years on a development? You don't even know if it's going to work out. When you just, the accumulation of potentially 2, 3, 4 bread and butters in that time, the cumulative effect, plus your diversity, plus your de-risking, it's a no-brainer. The DRDs at the back end when you got more buffers and you're not really too scared to do things. You got the safety nets, but when you're starting out, it just seems to me the opposite of what you should be doing.
Agree with you, mate. 100%. What are your notes, buddy?
Well, all of you guys did really well, but like the other one, I will have a stronger finish to make sure that we end in a really strong note. So when
he's starting,
it's a long lead in. It's a weak start. Let's see how good this supposed strong finish is.
Week long.
Fucking feels like it.
Week start, week long.
One of the points was, and I'm guilty of this, is not making more of the window to buy when you could. And I did this. I should have bought more at that time. There was a window there. And I know we've talked about this a little bit, but we often see clients, they get a really good result. And whether it's interest rates or not, they just go, I'm just going to see how this goes for the next year.
Yeah.
And then I'll come back. And then you think to yourself, dude, look, why? Why would you be doing that? And for me, whether it's you're lazy or whether it's this or you're not ready or blah, blah, blah. But when you look back in hindsight, you think, shit. And we've all said this. We said this before when we were having a coffee. Should have bloody bought a couple more, shouldn't we? You should have done this, should have done that. And we're saying that. So when you got that window, and you said it in the other podcast, when you're swinging for it, and if it's in your hit zone, keep swinging. If you can do it, you got the means and the numbers make sense, don't stop.
Yeah.
You've seen, you often talk about this, right?
The example before of COVID.
Yeah, 100%.
Like I had
that was it.
There. I had the crack and I was like, well, I either do this thing or I don't. And there we go. It worked out.
The other thing was a couple of things. On the maintenance side of your properties, don't neglect that and just think it's all too hard and let the maintenance almost diminish your resolve, right? Because sometimes when you have more properties, more shit goes wrong and you're thinking, shit, I don't know if I should be doing this anymore. And I've felt that too because I had a certain bill that I was thinking, oh, shit. There's a few run-on things. And it wasn't until you step back and you realize that property's increased $200,000-300,000 or whatever that you go, no, fair enough. I can cop $3,000 or $4,000 or whatever.
That cracked roof tile.
I literally had that in my head just then. Like, this dude he's got $500 worth of roof maintenance 8 months after we bought it. The property's gone up 500. It's gone up 100,000. My email back to him was, "Mate, you're never going to make it as an investor."
Yeah,
done.
Yeah.
Like, man, you're kidding. Like,
So don't
you know
let
what I mean?
those things let those things throw you off, because that is part of the course. You have to expect it.
It is all part of it. Working with bricks and mortar, we're working with people. Things are going to break. Things are going to happen. Like Paulie's example before of 2 months of not vacancy, but it was an issue with a tenant. 2 months without rent. It's all part of the journey. If you can't strap yourself in, and this is why we start with smaller level deals. That's why I love to start with good, solid bread and butters, because you're limiting how many things can potentially go wrong on it. You're cutting your teeth on the correct level of deal, and you can still get great results out of them, but you're not trying to go too far too soon. But at the end of the day, we're working with bricks and mortar, and we're working with people, and things can happen. So if you can't build the resolve to deal with that shit as it comes up, and it gets easier. I got 54 property portfolio as of today with over 70 bloody rentals. I cop shit. You know, like a lot of stuff comes up from that end. You just got to deal with it. You deal with it and work with it. But I can say that now so confidently and so calmly, because I was a stress head when things blew up, back in the day as well. And it was worrying, it was stressful, it was all the rest of it. But it's part of the journey. Yeah, and you got to you're always trying to take things from these potty guys, and these are the things you have to take. 4 experienced investors sitting at a table saying, it's all good. When things break, it's part of the journey. You know what I mean? And as part of it, you've got to have a look at the bigger picture and not spook yourself out from little things that happen.
Yeah, well, we talked about my first deal with the dog poo on the wall.
Yeah.
That I balked at that to begin with, and then little.
I thought you bought it because of that.
100%. That was the appeal to it straight away.
Own a rock appeal. Here we go.
But it was a little bit of maintenance at that time.
Yeah.
Put a bit of money in, fixed it all up, and then I look back 3 years later, the thing's doubled.
Yeah.
Had I had booked on that and not gone ahead with that deal, I wouldn't be in the position I am in today.
And you'd be kicking yourself.
Oh, absolutely.
You'd be kicking yourself.
Yeah. So
yeah, man. No, I'm with you. It's a massive point. Very, very solid point.
And on the flip side of your maintenance, just from your paperwork, right, and just your files keeping and so forth, I found for myself the reason why I took so long to get my pre-approvals done with another broker is because I just had things all over the shop. It was just too hard basket, and that's kept me out of the market for a bit, so missed opportunities. So don't put it off. Just do the little 1% as well, and then all of those together add up to the result.
100%.
So stay on top of that.
Yeah.
And then the last thing, guys, it wouldn't be a section from me if we didn't talk about
mindset.
Mindset.
My name's Jimmy.
I would like to talk about the mindset.
I am Dr. Jimmy on the Jimmy Lab.
We are going to talk about mindset today.
Oh, Lucky's pretty
that was pretty
Go on,
good
Paulie.
from
What do you
you.
got? What do you got, Paulie?
I was looking at like Jimmy Neutron, something like that.
Oh, his hair looks a bit like
Well,
that 3-year-old.
What I was going to say, and often we talk about this to Sammy Boy, but you need to celebrate the wins along the way, because otherwise, why the hell are you doing this? There's going to be shit you're dealing with. There's going to be challenges. You want to do more. You want to proceed. You want to get bigger. But if you're not actually celebrating a little bit, whatever that means to you, going out for dinner, treating yourself, whatever. But just make sure you take some time to give yourself a pat on the back. Otherwise, you will never be happy, because the destination happiness of one day I'll be happy, at 10 properties to 20 to 30 to 50 to 100, there's always going to be the moving goalpost. So take the time to acknowledge what you've done. Give yourself a pat on the back.
Very true, mate. It's a great comment. It's a great call. And I think for most people, especially when you're going through the intermediate phase, every deal is a win, right? You should be celebrating
100%.
every deal you put in. When you start going past 10 plus, it starts to feel a little bit more, it just feels like more of the process. You're used to it. It
More of a
starts
business,
being, yeah, 100%, man. Like I don't even think about it these days when I buy things. There's a couple of big ones that come through and are like, all right, that's worth celebrating. But most of the other time, I don't even think about it. Especially most of my stuff's pretty hectic renovator, so I'm just thinking about the work that's involved with it. But it's all part of it. But I think, especially when you're in this intermediate phase, pretty much from 0 properties through to your 10, you should be celebrating every single one of those, because every single one's special and it's important. And if you're doing the right deals, it's going to be moving you towards ultimately whatever that goal is that you're chasing as well. So, man, Jimmy, I agree with you completely on that. You need to do it. And mate, the amount of time we spent together is something that you really started drilling into me a lot as well, because I would just go and go and go, and I'd do a whole year without a holiday, without a reward or anything like that. And it's not that I didn't think about it or did think about it, whatever. I was just fixated on what I was doing, but I wasn't stopping and smelling the roses and celebrating the wins as I kind of went through as well. So that's great advice, man. I think it's a very, very strong point people should take on board.
That's it from me.
One good one from 3. Thank you, Jimmy. 3 from 3. 3 from 3. 4 from 3. 1 from 3.
Well done, guys. It was awesome again. I think the intermediate one was just as good as the beginner one. I'm looking forward to it.
I enjoyed it.
Are we thinking the advance is going to take off, the next one?
What do you mean if it's going to take off?
Like, should we be doing it? Because I remember last time you said, depending on how well the beginner one goes,
I'll
we'll
review
do the
your
intermediate.
notes. The three amigos might do
It
it.
might be a trio.
One thing, guys, don't worry. I will carry the slack at the end and make sure we get over the line. So anyway, there we
All right,
go.
mate. The three amigos and the dirty Mexican. Beautiful. Listeners, thank you once again for tuning in. Big boys, thank you for coming in once again and recording another Common Investor Mistakes episode. It's been an absolute pleasure, boys. I hope you enjoyed this episode, listeners. If there's anyone that you think might also take some great value from this app, please make sure you send it on. We want to keep sharing the love, keep building this community of people who are thinking, talking, and acting the way that we do around property investing and taking that property investment to another level. If you haven't followed us on the socials yet, you can jump over to @Australian Property Scout. Follow us all there. Jump on. You're going to get the regular feeds of all the content. You're going to get the reels. You get the bloopers with Lukey. You get recent deals. You get a lot of good stuff. So make sure you're following us on all the socials. And if you haven't left us a 5-star review yet, make sure you jump on. You leave us a 5-star review. If you're loving these episodes, also make sure you hit the subscribe button. It'll make sure you get a pop-up, you get alert every single time that we drop an app for you guys. And other than that, I hope you all loved it, and I'll see you next week for another Scouting Australia podcast.